Good morning and welcome to this Wednesday, November 30th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, today's the last day of November. Unbelievable. 11 months in the books. One more month to go, and then we've got 2023. I don't know about everybody else, but it seems like the year has just flown by. Really hard to believe we're heading into the Christmas season, another new year around the corner. But it is what it is. Time doesn't stop. This morning, we've had a little issue here with the market, especially on the NASDAQ side of late. And I'm going to point out some of the issues here in just a minute. Futures were up a little bit stronger earlier, but they have they have come back down right now, or as of 10 minutes ago. The Dow futures were down about 4. S&P 500 futures were flat. NASDAQ futures up about 10. Of course, everybody waiting for Fed Chief Powell. He's going to talk a little bit about the economy. And so I guess everyone's on the edge of their seats. And of course, we know that between the combination of the Fed and the inflation reports, that's been when the market has struggled the most, when they've had to deal with those two, items firsthand. So we'll see what happens today. I do think we're sitting at a pretty key area in terms of support for the market, especially on the NASDAQ. So this is going to be really interesting. The 10-year Treasury yield this morning is up about 3.5 basis points, 3.78%. We were as low as 365 yesterday. So the fact that we're now back up to 378, you can see there are a lot of folks bailing out of treasuries ahead of the Fed speech today. And we'll see whether or not, that makes an impact or has an impact on both bond and stock markets, but that will be later today. So we'll be watching for that throughout the day. Anyhow, before I jump into everything, because I do have some interesting charts to show you, I thought we would go ahead and start over at Earnings Beats, as we always do. Want to just make sure you're aware. If you are new to Earnings Beats and you go to earningsbeats.com, you can scroll down and you will find our free Earnings Beats Digest newsletter. This morning, I wrote an article, a brief article, and all these articles are pretty short, usually just a couple paragraphs in a chart. But today I was writing about our short squeeze chart list and the stock that's the most heavily shorted stock out there right now, which is Bed Bath & Beyond, ticker symbols BBBY, and just showing how, these heavily shorted stocks, you want to be in them when they're making their moves for the potential short squeeze, but buying and holding is probably not the best idea because they just continue to drift lower and lower. Anyhow, that was the subject of this morning's EB Digest. We try to cover a lot of different topics, mostly relating to earnings and relative strength, candles, gaps, moving averages, trend lines, all of those types of things. But I think it's a very educational newsletter. At least that's what I try to make it. And all it takes is a name and an email address. Hit that subscribe button. We'll get you set up. Also, all of our free events you'll be invited to if you're on our EB Digest newsletter subscriber list. So, and we do a bunch of them throughout the year. We have a huge one coming up Saturday, January 7th. That will be our Market Vision 2023 event, where I will give you my outlook for 2023. I think the outlooks I've given the last 3 years have been pretty spot on. We'll see what happens in 2023. But anyway, mark your calendar for Saturday, January 7th. And if you don't want to miss it, please make sure you are signed up for the Earnings Beats Digest newsletter. There's no credit card required for this, by the way, and you can unsubscribe at any time, but you should check that out. All right, so what happened yesterday? Well, the Dow Jones, as you can see, went up 3 points, so not really much there. S&P down 6, okay, not really too bad. We're hanging above the 20-day. The Dow, you can see we got up right about to where we had been back in August. I think we closed just above last Wednesday and Friday, and we're starting to back off of it a little bit. Looks to me like maybe a slight negative divergence. So maybe we'll start to see some of that money rotate away from the Dow that's been carrying it higher. But at least for now, The Dow still seems pretty healthy up above that 20-day moving average, and a move back above the August high and the high we saw last week would be bullish. S&P, again, trending above the 20-day, I think still looks good here. Here's where the problems come in on the NASDAQ. And it's a little surprising because since the October CPI came out back on November 10th, we've seen the 10-year Treasury yield drop as much as almost 70 basis points. And so what I would have expected, if you had told me ahead of time, hey, the 10-year Treasury yield is going to drop 70 basis points, I would have expected the NASDAQ to look like this and the Dow to look like this. And it's not happened. We've seen kind of the opposite. But again, I'll show you some other charts on this. I don't want to talk about it too much right here, but I'll show you a couple of charts that I think make it pretty visual as to what's taking place in the market right now, which is a little concerning, I'll be honest. Mid caps up 7, small caps up 5. So you can see bifurcated action. Small caps, mid caps, the Dow all up, S&P, NASDAQ down. From a sector perspective, we saw real estate leading up almost 1.7% after a pretty rough day the prior day. Energy, same thing. After being down the prior day, bounced back nicely, up 1.5% yesterday. Industrials up 0.6%. Financials right about that same amount. The big loser yesterday was technology. Technology definitely taking it on the chin. A little surprising to me. And you can see the XLK finished at 129.46, which we had 130 as that resistance we broke out. We held 130 on the pullback there. So we're a little below 130. And then also the 20-day moving average is at 129.68. So we're slightly below the 20-day, and we're slightly below price support. I really would like to see the NASDAQ bounce from here. And that's why I think this speech today with the Fed is going to be pretty critical in the near term. Because if the Fed, if Fed Chief Powell does what he's done in the recent past, which is try to spook the market, and I say try to spook the market, I mean he's trying to spook the market. He wants things to slow down. So if he can't get it through rate hikes, he's going to get it by talking tough. He'll do whatever it takes. So I'm a little nervous with the Fed speaking, with Powell speaking today, knowing that the technology group is sitting right here on edge. Doesn't mean I think we're going to go back down to the lows, although it's possible. I just feel like we've got to be careful here in the near term, especially if the key areas of the market, the growth areas, react negatively to whatever Fed Chief Powell says. So that will be worth watching. I'm sure there's going to be a lot of traders keeping an eye on that, probably with one foot or one finger on the sell button on technology stocks. So let's see not only how the market does, but how the relationship between the key indices. How does the NASDAQ do relative to the S&P 500 while Powell is speaking? And then also once he's done, how does the market react to this? I think that's going to be critical in the near term for the stock market. So we'll see again what happens there. 10-year Treasury yield. So again, this morning right now, 3.766. So we are up about 2 basis points, still below the 20-day, which is at 3.83. The 50 days at 3.90. And those recent highs are at about 3.91, 3.92. So that's really the area right in here that as long as the 10-year Treasury yield stays at or below those levels that I just gave you and continues to drift lower, goes back down and takes out this double bottom, I would expect money to rotate into the more aggressive areas, growth areas. That hasn't exactly been happening. I'm going to show you what I'm talking about now. So let's first take a look at the S&P 500. And oh, by the way, we did get the ADP employment report out this morning. And it showed we were expecting 200,000 jobs, and it came in at 127,000. So positive, but less than expected, which I actually think is right about where I'd like to see non-farm payrolls on Friday as well. Last month, we were at 239,000 on the ADP employment report. This month, expecting a drop to 200, and we actually came in at 127. So I think that's a good thing. The Q3 GDP, however, which the first estimate came in at 2.6%, And we were expecting the second estimate to be 2.7%. It was 2.9. So it was a little hotter, a little higher than expected. So we had the ADP employment report, which I thought was good news, kind of what the Fed's hoping for. But then the GDP was higher than expected, which is a little opposite. And the Fed really isn't, they want to kind of keep growth very moderate or slow, not accelerating. So both these reports, I thought, just kind of like the market, a little bifurcated. Whether or not that carries over into anything that we need to be aware of in terms of the 10-year Treasury yield, I don't know. Keep watching. Again, if we go back to that chart, I would say 391, 392. I can be okay up to about that level, but anything above that starts to look more like this is sideways consolidating, which would not be good for the growth stocks. All right. So anyway, here's your S&P 500 trending up above the 20-day. Pulling back and testing the 20-day is no big deal. I don't worry about that. I look at what's going on beyond the surface of the market. It's like, somebody washes their car and brings it up to you. It looks like a nice car. It's been washed, looks good on the outside, but you don't know how it runs until you start the engine or try to start the engine. And that's kind of the market. When you're looking at the S&P 500, sometimes you might like what you see, but you might not like what's going on underneath, when you go to start the engine. And that's where we're having some difficulties right now. So let me show you what I'm talking about here. So this is a 15-day, 10-minute chart of the S&P 500. Down below is the 10-year Treasury yield. Then we've got these ratios that I like to follow, the QQQ versus the spider. That's just the NASDAQ, how it's performing versus the S&P 500. The XLY versus the XLP, which is discretionary versus staples. And then the IWF, IWD, which is large cap growth versus large cap value. So just looking at these three ratios, along with the 10-year Treasury yield and the S&P 500, let me show you what has transpired here since that October CPI report came out right here. So we got that report, and it was great news. It was great news on the inflation front. It was great news on perhaps what the Fed might do going forward. They want to see a series of these reports, but you can't have a series until you have the first one. So it was good to get that good news. So November 10th, we gap up and we continue going higher in the S&P 500. The 10-year Treasury yield, of course, with that tame inflation report, drops as we would expect. So the 10-year Treasury yield takes a big drop and it continues going down the next several days. Well, these first 4 days were very bullish for equities. I mean, you can see not only was the S&P going up and interest rates coming down, but look at the relative strength here. The QQQ outperforming the spider. Perfect. The XLY jumping against the XLP. Perfect. The IWF going up versus the IWD. Perfect. All money is rotating into growth areas. But since then, now I know the 10-year Treasury yield for the most part has been flat, little ups and little downs. But if you look at the ratios, we're not getting any flat. We're going down. We've been trending lower. When we get these little pops in the yield, you can see we're taking some pretty big hits in these relative ratios. And then when we pull back, we get a little bit of a bounce. And then as soon as we start to show any strength again in the yield, immediately money starts rotating again out of growth areas. So we've given back a lot of what we gained. So the S&P 500, which moved up, and we're still way above where we were back on November 9th. See that? I mean, we're up over 3950, which is still above 3900, by the way, which is good. And we were down 3750. So we're up 200 points on the S&P 500. And with rates still way down, we've lost much of that rotation into growth. You can see the QQQ spider. We're not all the way back down to where we were, but we're a lot closer than what the S&P 500 would suggest. And then if you look at the XLY, XLP, and I know Tesla and Amazon were both having really, really rough periods in through here, and they've started to bounce a little bit. But we went all the way back down, essentially, to where we were before that inflation news came out and before the 10-year Treasury yield dropped 50 basis points. So I'm not there. I've got a couple things going through my mind. One is obviously that this time of the year normally favors areas like the financials and the industrials, more value oriented areas. So part of this could be seasonal. Part of it could be the stock market just isn't nearly as smart as the bond market. The bond market's coming down. Money should be rotating into growth, and eventually it will. It's just not yet. Or the third thing that we have to consider is that potentially this could be a bearish signal. Now, I'm not where I was back at the beginning of the year, and I've talked about this. I don't really want to spend a whole lot of time on it, but we've had plenty of signals. We had plenty of signals back at the beginning of the year that said we needed to be careful. Many of those signals are no longer a problem. So when I'm looking at this, remember, these are secondary indicators. These are not primary indicators. So I'm not going to base my, my review or base my opinion on the market on just these three ratios. But this is a part of the puzzle. And right now, it's a part of the puzzle that quite honestly doesn't make a lot of sense. Because again, when we're holding, the recent support, that November 17th low, if I pull up the NASDAQ 100 on this same chart, see this low right here? We went slightly below it there, and we were slightly below it again yesterday. So see how we're kind of rotating away from the NASDAQ 100 and into the spider on a relative basis. Here's that same low. This low never got down there. This low, we keep putting in the higher lows here and the lower lows on the NASDAQ 100. Again, I'm not sure exactly what it means. I don't know if it's a big warning sign or if it's just something that will take care of itself over time. But with that having been said, there's nothing more important than price volume. That is our number one indicator. That's the primary indicator. When I talk about ratios being secondary indicators, what I'm looking for are for those indicators to support or dispute what I am seeing on the price chart of the major indices. So as I look at the NASDAQ 100, I'm still okay. We did close just slightly below the 20. I'm going to shorten this chart so we can get a really good look at what's been happening. But you can see on this 3-month chart how we've closed just a little bit below that 20-day moving average. And if I use the inspector here, remember this was the open at 11,521 right there. 11,521 was that open. Here was the low of 11,503 back on November 22nd. We closed yesterday at 11,503. I mean, so if we're not below these levels, we are certainly on the verge of going below these levels and moving to about a 2-week low. While the yields are down. Again, at least makes you think a little bit here, right? The other price point that I've talked about, and I think honestly, this is the level that we've got to really be watching. This is the gap up from that new fundamental information we had out on the October CPI. We opened at 11,350. That's the top of a very significant gap with massive volume. NASDAQ 100, except for Quad Witching Day, which was back on the 3rd Friday of September, this was the biggest volume of the entire quarter, last 3 months. And with that volume, we gapped up and we saw buying all day long, closing on the high. The next day, still very heavy volume. Same thing. That is a lot of accumulation coming from that 11,350 level. Look at where the 50-day moving average is right now, 11,330. So you got 11,330 here, 11,350 here, losing the 20-day and this price support barely. If we are weak today or over the next several days, and we go down into this area, we need to hold. And by the way, if we set another new low today, I would be really careful in any juiced or leveraged ETFs on the NASDAQ. I like to play these. I like to be in on the leverage side when we're trending higher. But if we start to break down, I don't like holding any leverage. If I'm going to be in the NASDAQ down to say this level, that's fine, but I don't need to be in the double or triple ETFs that track the NASDAQ 100, which would be the QLD, which is 2 times, and then the TQQQ, which is 3 times. I think when you're trending, you can make a lot of money in those. When you're not, and you start to move lower and start to lose some key support areas, moving averages, that's where I would rather be much more cautious. If I want to be in the QQQ, that's fine, but I'd be careful with leverage when the market is no longer in an uptrend. And I think that's starting to come into question right about now in the NASDAQ 100. We need to see a rally here. All right, earnings. We got about 10 more minutes here. So let's take a look at some of the earnings, because the earnings picked back up again last night. We had a few names, especially among the growth in the growth area, that maybe are worth taking a look at to see not only what they reported in terms of bottom line, but also how the market is reacting this morning. So let's start with Intuit. Intuit had a great report in terms of bottom line. They were expected to post $1.19, and they posted $1.66. But the AD line wasn't great. I was talking about this one on the show. I think it was yesterday. I just thought, number one, you're in software. Be careful. This is a really tough area. The AD line is not exactly flying higher. I just, we're meandering lower in price. It was one of them that I was a little concerned with. I would never have held a stock like this into its earnings report. And I think, well, let's see what it was doing this morning. Okay, it's up a fraction, up about 1/3 of 1%. So it is up slightly. But considering those numbers, $1.66 versus $1.19, and you get $1 out of the price after losing $6 yesterday, I don't know. It just seems like maybe pretty shallow type of reaction. Next up, Workday. Workday had a great reaction. Expected to earn 84 cents. They came in at 99 cents. Stock up almost 10% in after hours with, there you go, 9 minutes to go before the market opens. Trading up almost 10% today. 157.09 puts us up right about here. We got work to do. We got to close above about 161 before I would start to get more bullish the stock. So this is a situation where we might get a gap up. Maybe we go up and test. But if we can't close above this level, short term, I wouldn't be surprised to see a pullback. CrowdStrike. This was not good. CrowdStrike down to 18%. Now, they beat on their bottom line. I also saw they beat on their top line. So beat on revenues, beat on earnings per share. Earnings per share came in at 40 cents. Market was expecting 32. And you're like, what the heck? Why is it down 18%? They warned about revenues next quarter. Said they were going to miss their previous guidance with revenues. 18% of the value of the company shaved off because they're going to miss their revenues next quarter. Seems a little steep to me. But again, when you're looking at the price chart, I mean, look at what's been going on with CrowdStrike. It was 205 back in August. Remember, we had that big run in August, 205. We were at, well, now we're 113. So we're almost cut in half in the last 3 months. It's brutal with these growth stocks when they're not working out well. Now, again, if you got good numbers and the market starts getting a better mood and rates start to drop, we got a different ball game. But we got Powell on deck. We're going to see what happens there. A couple other earnings. Let's see. HPE. Hewlett Packard Enterprise up 2.4% this morning. It's been moving up. This one actually looks pretty good on the chart. I don't know if it can't break out above that 16 level with its earnings. It's had such a huge run. We could easily see a sell on news kind of thing here. So unless we get a lot of demand pouring in and a big breakout and a close above 16, I would be careful because of the big run we've already seen. This could definitely be buy on rumor, sell on news. HPE, by the way, matched expectations. That drives you crazy. You know, you look at something like CrowdStrike, which beat by 8 cents, and you're down 18%. And then you get a stock like HPE, which just simply matched expectations, and it's up 2.4%. Sometimes, And that's part of the problem too, I think, when a lot of folks look at companies based on their price earnings ratio. I mean, listen, I'm a former practicing CPA. I love my fundamentals, but I think looking solely at the valuation of a company based on its PE is a big mistake. Big mistake. Because Wall Street's, the big Wall Street firms are accumulating stocks based on their future potential. So if you're looking at a stock that maybe has a PE of 20 or 15 and you think that's high or low, you got to be careful. First of all, if it's a trailing 12 months, I find it almost useless. If it's the next 12 months, that's a little bit better. But still, the market is looking at future growth of these companies. And if a company has a PE of 20, 25 based on next year's earnings, and you think that's really high, but this is a company that could grow their earnings by 30, 40% a year, I can promise you that multiple's not high. So there's a lot that goes into it. It's not just a PE ratio. You got to be careful. All right, Network Appliance also reported last night. And down 11%, not good. This is one that had been trending up over the last couple months heading into its earnings report. But it's looking to open down around the 63, 64 area, all the way down here. You can see very good support around 61. So if it opens above 61 and then comes back down and tests this area, I mean, you could certainly give it a shot near the support. But if that failed on a closing basis, I would be out of the stock. What I would really like to see, when I look at something like this, I like to see an intraday move below where it will trigger more stops, because nobody in their right mind other than market makers would be buying a stock that starts to trigger stops. If they want to accumulate shares for an institutional client, that's a great way to do it. You put in new lows for the last 6 months, and a lot of folks have their stops there. If market makers need to accumulate shares, that's a really good place to do it, and cheap. So if you go below these levels and then you bounce back up at the close, it's a pretty good indication that market makers are buying. And if they're buying, generally I want to buy. So anyway, that's just one way that I look at the market sometimes. Let's go ahead. We got a couple minutes left. The next three, what we'll do is we'll use these as the three you must see. Actually, I'll pull up four, just see how they're doing. These are all companies that reported their earnings this morning. So Royal Bank of Canada up 1.25%. Looking at the chart there, looks pretty good. Probably going to have a negative divergence, I bet, if it goes back up to a new high. Maybe we'll look at that one. Hormel down 2.5%. So it's going to be back down. Looks like below the 20-day moving average. It's a pretty key area, though, of support. A lot of overhead resistance at about 47 before we broke out. And then we went down, held the 20-day, and went right back up again. So I think that 47 level would be really important. We'll look at that one. And then this is actually one of the internet stocks that had been performing really well on a relative basis. And it went up 6% with its earnings yesterday. I was breaking down, I think this was yesterday's show over at Stock Charts. I was breaking down the communication services group. We looked at internet stocks. And I showed everyone, if you pull up our strong earnings chart list at Earnings Beats, how you can pull up in the search box, you can just pull up communication services, or even more specifically, internet if you want. And then it'll list all the companies on our strong earnings chart list in scooter order, which is a relative strength indicator at Stock Charts. And this was one of the stocks, one of the few in communication services that had a scooter score above 50. Most of these stocks have been getting hammered to the downside, and they're relatively poor. They have very, very poor relative charts. This one is a little bit different, and I pointed that out yesterday. Now they come out with earnings. They're up 6% with earnings. So relative strength, all the things we do, it does matter. We'll look at this chart in just a second. And then the last one is DCI. So this is Donaldson, and they're up 6%. But also have moved up pretty good. I'll tell you what, let's real quick, let's look at these three. Let's look at the Royal Bank of Canada. Went back down, hit that 20-day at 98. Nice little hammer. I think it's probably going to bounce and go back up to about 101 and change here. And if it does break out I would just be careful. Watch this PPO and make sure that PPO goes up with it. If it doesn't, we could be, maybe we go up a little higher, but then the negative divergence could kick in and start to, we might see some selling pick up at that point. All right, next up, let's look at this BEKE. So again, big 6% move with its earnings. There it is, gapping up a little bit. Actually, it's only gapping up a little less than 6%. Still moving to a new high. That's good. I believe this one's the internet space. Let's pull up this on a relative chart. Yeah, internet going down. You can see it here relative to internet. It's near a 52-week high. So it's a good stock within a really bad area. All right. And the last one I wanted to show you was this DCI. Nice move, and it is moving up, trying to make that breakout above 61 and a quarter. Until these last couple of days, AD line's been really nice. That's good. Relative strength moving to a new 52-week high versus industrial machinery peers. So this is a nice looking chart, and we're getting a nice reaction. Whether or not we can hold it on a breakout, we'll see. We'll know by later today. Anyhow, that's it for me. Let's see what the market's doing, see if it's down again or if it's trying to bounce. It's bouncing a little, not much. Dow up 42, S&P up 6, NASDAQ up 17. VIX still 22. I mean, market's been struggling a little bit. VIX still hanging down there. I did mention, I think also yesterday, that if we see the VIX go below 16, we've not had a bear market where the VIX has been 16. Keep that in mind. That would be one of the sentiment signals that there is no more bear market. Right now, still in the 20s. That's about where we bounced in the past, right around 20, maybe a little below that. So this could be definitely is a chance for the bears to try and regain some semblance of control here, especially on the NASDAQ. So we'll want to watch this throughout the day. All right, that's it for me. I'll be back tomorrow over at Stock Charts TV. So you go in here, click on this Stock Charts TV at 9 a.m. and you can check out my next Trading Places live show. I want to wish everybody a great day, and I'll be back tomorrow. Happy trading.